When you think of alternative assets, have you ever thought about the income stream associated with recording contracts? We'll talk about that.
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This past week, we spoke with David Vanka, who is the portfolio manager for ICM, which is a music royalties company, Crescendo Music, here in Canada. And one of the things that I found fascinating in my conversation with David is that as people try to make better wealth decisions, they oftentimes keep the opportunity set narrow, which is to say they think about traditional things, mutual funds or exchange traded funds, stocks and bonds, and they're going to be talking about traditional asset classes, Canadian stocks, U.S. stocks, bonds, maybe GICs, what have you. And they think very narrowly about just the things that they know and that are frequently on the headlines of a newspaper in terms of the options that you might have in making decisions about how to invest using just the usual tools. What many people don't realize is that there are a number of products out there that are great in terms of risk and return, that offer good value, that are oftentimes excellent diversifiers, that are uncommon, that you might not think of. And as a result of not thinking about them, you don't really explore buying them because you oftentimes don't even know they exist. So the product that we talked about this past week is one of those products. You can buy a diversified basket of music royalties. That's either the money that is made by writing a song or the money that is made by recording a song and having people stream it. There's a very strong, stable, predictable income stream associated with music royalties. The return that you can get is oftentimes high single digits. In fact, it's usually high single digits with very little variance, which is to say a bad year is medium single digits and a great year is low double digits. But the return is very stable. It's very predictable. And it's the sort of thing that a lot of people can use. And it works really well for almost all investors. Even if you're a retiree with a fixed income and you want to be conservative, it's useful because the likelihood of a major drawdown is rather modest. If on the other hand, you're young and aggressive and you want growth, well, getting growth of 8 or 9% is the sort of thing that most people would be happy with most of the time. Remember that FP Canada has put out its assumptions guidelines for the rates of return we should be expecting for major asset classes for the next decade. And Canadian stocks and U.S. stocks planners are being told to plan using the assumption of a rate of return of somewhere between 6 and 7% for the asset class. And remember, that's for the asset class. That's before you take into account the cost of the product and the cost of advice you might be having to pay in order to get access to that product. It's not uncommon, therefore, for a portfolio made up of strictly Canadian and U.S. stocks, if those products cost 20 or 30 basis points, 0.2 or 0.3% to buy as a product cost, and the advisor charges, let's say, a traditional 1% fee, it's not uncommon to expect a return of, say, 5.5% for stocks. Well, music royalties can pay 7.5 or 8 or 8.5 or 9, higher returns than people should be reasonably expecting. In other words, I would say that for the next decade, it's reasonable to expect that you get higher returns for music royalties than you get in traditional stocks with less risk and very predictable cash flow, which is to say the highs are not going to be super high, but the lows will not be low. In fact, it's extremely unlikely that the lows will be negative ever. So it's the sort of thing that a lot of people can use as a portfolio add-on. And I'm not suggesting it be a lot, but one of the things that David talked about was 5 to 10%. And I think that's a reasonable allocation towards something like this. Remember that it oftentimes takes you a couple of months to get the money out. So if you need the money, you can't get it the next day the way you could if it was a stock or a bond or a mutual fund or an exchange traded fund. But typically 2 months notice is not a big deal for most people. Most people will plan their finances. If they're going to buy a car, they'll know 2 months in advance that they're going to buy the car and they can do the redemption to be ready, as an example. So using uncommon products, things that are a little bit off the beaten path, like music royalties, are a great way to enhance your wealth, to improve your risk-adjusted returns, and ultimately to make better wealth decisions.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.